I'm SELINA WANG in San Francisco, in for Emily Chang. This is Bloomberg Technology. Coming up in the next hour, Tesla CEO Elon Musk offers a bit more clarity on his funding secured tweet, pointing to interest from Saudi Arabia's sovereign wealth fund. But questions still remain. We'll discuss. Plus, the CFO of Netflix is stepping down after overseeing a cash-fueled expansion that turned the company into a rival for Hollywood studios. So what's next for the streaming giant? And Chinese tech earnings. Beijing's regulators stepped in and forced Tencent to halt downloads of a popular new game. What that means for the social media giant ahead of its second quarter results. But first to our top story. Elon Musk is elaborating on what sparked his move to take Tesla private. The electric car maker CEO said the key to the gambit was the interest shown by Saudi Arabia's sovereign wealth fund. Musk says the Saudis approached him almost 2 years ago about taking Tesla off the market. The fund recently bought an almost 5% stake. For more, I want to bring in Oppenheimer senior analyst Colin Rush, who joins us by phone. Also with us in New York is Bloomberg Businessweek's Max Chaffkin. Max, I want to start off with you. Elon says he's continuing these talks with the Saudi fund, that he's also talking to other large shareholders. Do we have any idea who those large shareholders are and just how far along these talks are?
No, we have no ideas about anything, in fact. And I think there's sort of, even with the information that came out this morning from Elon Musk's blog post, there's sort of a wide range of possibilities that could have happened. I mean, we know that there was some kind of concrete conversation between the Saudis and Elon Musk, I believe, on July 31st. I mean, that timing that's pretty tight for a buyout. We don't know if they talked about price. So the blog post says, there's going to be some due diligence needed and some various vague things that would need to happen. We don't know if they've actually come to any kind of agreement. In terms of large shareholders, we're going to be talking about sort of the big mutual funds, Fidelity, Vanguard, and so on, that own big chunks of Tesla stock.
Colin, so a lot of questions here, as Max mentioned, possibilities, large mutual funds, et cetera. But what are the other possibilities here? Is there a scenario where Elon Musk brings in some of his other billionaire tech friends in Silicon Valley to help invest?
And the truth of the matter is that we really don't know, as Max mentioned. We don't know what a structure would look like. What the number of shares would be that people would need to buy to actually take this company private. What sort of dividend there might be, if any. What sort of liquidity profile. There's just an extraordinarily limited amount of information at this point to make any sort of assessment on what's happening here.
And now, Colin, he also snuck in his blog post that he considers himself a potential bidder. Doesn't that bring in a host of legal issues, given that he is the CEO and chairman of the company?
Absolutely. You have to go through a legal process to provide a tender for a company in this regard. And, it sounds like from the flurry of tweets and blog posts that this is all happening on the fly. And in some regard, in response to the legal backlash that they're seeing, given the fact that it sounds like the tweets maybe were a little bit ahead of the process.
So, Max, there are these continuing discussions with the Saudis, but doesn't this bring into question the Committee on Foreign Investments here? I'm sure they would take issue with a large foreign investor taking a stake in this iconic American company. Yeah,
I mean, and I think especially in the Trump era, where we've seen the administration sort of willing to kind of do new things to protect, as they see it, American national security. I think that's certainly an issue. I mean, obviously, the American relationship with Saudi Arabia is not, nearly as contentious as the relationship with China, where we've seen, the Trump administration really, take action in some dramatic ways. The other thing that's sort of interesting about this, a colleague, Liam Denning, wrote a really interesting column earlier today about how by doing this, Musk has kind of given quite a lot of leverage to the Saudis, because now, he's already sort of said funding secure, this is just going to happen. If they were able to sort of put out something that would put a little cold water on this, that seems like it would throw this whole process into kind of chaos. So it's sort of a perplexing chain of events, to be honest.
Yeah, and Colin, on that note, I want to get your take on a question that our Tesla reporter posed in a piece today. She said, is Elon Musk in the midst of pulling off the go-to private deal of the century, or is he making the best of a weak hand in high-stakes poker?
I mean, I can't really say which way this is going to play out at this point. Like I said earlier, we're still waiting on a great deal of information, and the company still has to perform. And so even if they do go private at $420, that maybe, and some people are arguing that may be a way to cover up some of the concerns around hitting profitability in the public markets and not being able to reach those metrics. We obviously upgraded the stock a couple of weeks ago based on the potential for operating cash flow from the Model 3 if they're able to hit this 15% gross margin. But really, we're still, only a month into the quarter, a little bit more than that, and there's a lot of room to run here and a lot of unanswered questions.
Right, Max, bears would argue that Musk here is really the master of distraction. He's trying to get investors to look away from some of the financial issues, the production problems. What's your take on that?
I mean, I think Tesla, by any kind of objective standard, has had a pretty good couple of months. I mean, there were people who thought, it would be very hard for them to hit the 5,000 cars per week number for the Model 3, and now they seem to be hitting it comfortably. If you look at the Bloomberg production model, it's above 5,000 right now. So I think that's a good sign. I mean, that said, all of these issues that people have been worried about with Tesla are still there, and I think that if your core concern is, this is a company that doesn't totally have its stuff together, I'm not sure you're encouraged by, the events of the last few days. That said, if you're a believer, if you see this as a big growth opportunity, then, going private sounds good. And it's kind of the same story we've been hearing from Tesla for months and months, which is that, within a certain sort of vision and version of the facts, it looks great. And in another version, if you don't quite believe everything Elon Musk says, it looks, like a disaster waiting to happen.
All right. Well, Colin Rush of Oppenheimer and Bloomberg Business Week's Max Chafkin, thank you both for joining us. We'll be following this very closely. And another story we're watching, Alphabet's DeepMind plans to develop a medical product that will help doctors to detect more than 50 sight-threatening conditions from a common type of eye scan. The London-based artificial intelligence company has trained software to detect signs of disease better than human doctors. DeepMind and its research partners said they plan for prospective clinical trials of the technology in 2019. Coming up, a surprise shakeup in Netflix's leadership. Can a new CFO get subscriber growth back on track? We discuss next. And if you like Bloomberg News, check us out on the radio. You can listen to us on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. A surprise shakeup in the C-suite over at Netflix on Monday. Chief Financial Officer David Wells is stepping down after 8 years on the job. Since he joined Netflix in 2004, the company has gone from a DVD by mail service to the preeminent name in streaming content. It's also aggressively pumped billions of dollars into original content to take on traditional studios. Wells says he's leaving to focus on philanthropy, and CEO Reed Hastings had this to say about Wells' departure. He skillfully managed our finances during a phase of dramatic growth that has allowed us to create and bring amazing entertainment to our members all over the world while also delivering outstanding returns to our investors. With us to discuss, Crawford Del Prete, Chief Operating Officer at IDC Research, and in Princeton, Bloomberg Intelligence's Paul Sweeney. Paul, I want to start out with you. Do we have any other reasoning beside that he wants to join this philanthropy for why he's stepping down after 8 years?
No, we really haven't seen any other news come out of the company, and quite frankly, the stock is, not really reacting much at all. Oftentimes, when a CFO does depart, on short notice, it really raises concerns for investors, but that does not appear to be the case here. This appears to be a fairly well-managed departure, and David's going to stick around and help with the transition to a new CFO, and I suspect that there will be no shortage of A-list people looking for that slot.
Right, Crawford, judging by the stock reaction, it seems like investors aren't overly concerned. But what's your take on this? I mean, he did lead this company through the most dramatic phases of growth.
Yeah, so if you look at this company, it has transformed itself a number of times, and the basis for its competition continues to change. And I think that this represents the beginning of a new chapter for Netflix, and it's certainly a new chapter for David personally. David's had a great run at Netflix, and I think he's going to move on now to this philanthropy. I think for Netflix as a company, I wouldn't be surprised if they doubled down on analytics, doubled down on data to really try to figure out how they can delight customers and maybe even create new kinds of services around their content services in new ways. They are now competing increasingly not only against Hollywood, but against carriers, as we see carriers acquiring more and more content and throwing a lot of money at that content business. So the competitive landscape for Netflix is going to change, and I think that this is the beginning of a new chapter for the company.
Right, Paul, what are going to be the key priorities of this CFO coming in? Crawford mentioned a changing competitive landscape, carriers getting in as well.
As CFO, the first and foremost for the new CFO will be cash flow, trying to get this company to free cash flow positive. Right now, the company burns $3 to $4 billion a year in cash, and that is due primarily to their ever increasing programming budget, which is now north of $8 billion a year. They've been financing their growing programming investments in the debt markets, and that's something that obviously is not a long-term sustainable traditional way of funding it. So they clearly need to get their operations to cash flow positive. That appears to be, at least by our model, several years in the future. So there's going to be a real need to manage the cash flows of this company as it approaches cash flow, free cash flow positive.
And Crawford, what is the path to getting cash flow positive? They are aggressively pumping money into original content, and that doesn't look to be slowing down anytime soon.
No, they're going to. So this is the thing, that they're on this treadmill where they have to continue to create engaging content. They also have to continue to invest in the analytics to not only figure out, as a lot of people like to say, the way we watch, but what we watch, and make sure that they're dialed into the kind of content that's going to be compelling for people on a regular basis and really drive a social conversation around that. So this is why. So what's going to get them to that cash flow positive situation is growth, which is what we had the concern about last quarter. They have to be able to attract new users and engage new users in new ways in order for them to continue to have that top line continue to grow, while over time they figure out how to not do as much experimentation, but be able to reduce as a percent of revenue the costs associated with producing the content.
And Paul, do we have any idea who's on this list of potential successors? Would it be an internal promotion, an external hire?
I don't know at the moment. This is pretty late-breaking news, but what I will say is, again, there will be no shortage of A-list talent lining up at the door to get this position. This is, probably one of the most high-profile CFO positions in corporate America. With a huge company, a huge disruptor company, one that has a tremendous stock price momentum, so that can make it very attractive to a lot of candidates out there. So I think they will have the absolute pick of both internal and external candidates.
And Crawford, I want to get back to your point on competition. They have the traditional studios, they have the carriers, Disney's another existential threat. Yeah. What is the biggest concern for them moving forward?
Well, I think that their biggest concern is not getting into a war that is fought on many, many, many different fronts against some incredibly well-funded competitors, the likes of which, the biggest name on that list is Amazon. And from their standpoint, they're going to probably see companies like Microsoft experimenting in this space, getting into this space. We haven't really heard from Apple much in this space. So they could be fighting, their biggest problem here is how do they focus on delivering the kind of content that people crave, and also that people are going to get excited about and come back to for more, and not necessarily worry about all these upstarts that are going to be coming into their fray. I think that chief competition is really going to be coming from Amazon in the future. And
Netflix also relies on programming from other players.
Right.
And do you think they're going to increasingly be locked out from also being able to stream that content from, Disney, et cetera?
So look, this category, this company operates at a tremendous scale, and they have an unbelievable ability to be flexible and really look inward to figure out how to do new things. I don't think they're going to get locked out. I don't think they're going to let them happen. I think content aggregation is also a way for them to drive cash flow in the future.
All right, Bloomberg's Paul Sweeney, thanks for joining us, and IDC's Crawford Del Pret, you're sticking with us. Coming up, concern over turmoil in Turkey is creeping into global markets. So how is it impacting tech? We'll greet the market week next. And Bloomberg Technology is live streaming on Twitter. Check us out on @technology, and be sure to follow our global breaking news network @TikTok on Twitter. This is Bloomberg. Let's focus now on the markets. Turkey's the big driver this week as its currency plunges and a political dispute with the U.S. intensifies. The lira's depreciation is hitting a number of industries, from fashion to telecoms, and Turkey's public prosecutor has signaled there could be a clampdown on news and social media. And concerns are now spreading to the global markets. The S&P 500 kicked off the week by falling for a fourth straight day. Still, technology remains a bright spot as a number of big tech names made gains. Joining us to tie it all together is IDC Research COO Crawford Del Pret here in San Francisco, and in New York, Bloomberg Television Markets Editor Romain Bostick. Romain, I want to start out with you. The markets are clearly shaken here, and even the S&P is paring back some of its earlier rallies because of this. How do you see all of this unfolding?
Well, I mean, you're certainly seeing a lot of concern here. I think sort of the word that everyone has sort of been bandying around is the idea of taking a pause here. There's a lot of folks who don't really know how deep and how long this crisis is going to go in Turkey, and just how widespread the effects of it are going to be. So you're seeing a lot of money move to the sidelines. A lot of people just sort of take a breather until they can figure it out. Keep in mind that a big part of the reason why we had so many gains in this market here in the U.S. and even in Europe and in Asia over the last few months and over the last few years was because of this global synchronized growth story that everyone had bought into. And now what you're seeing is that that narrative doesn't really hold up quite the same as it did before. And so a lot of money is moving to the sidelines until it could find a new narrative.
And on top of this nosedive in Turkey, we have the trade war escalation, sure. We have the standoff with China, interest rates rising in emerging markets. I mean, how much further is investment sentiment going to fall in emerging markets?
Well, I mean, I think that there's just a lot of chatter and a lot of chop in these emerging markets. And I think that, to Romain's point, people are taking a step back to sort of see how things settle out. I don't think we have enough data to make a call on sort of what the impact of some of these issues are going to be, because we're really in a new era. We have government leadership in the U.S. with a different kind of negotiating tactic where where our president will put something out there and then people will kind of react to it. So you really have to take a month view, a month and a half, a 2-month view of these things to try to figure out what the real impact is, whether that's trade tariffs, whether that's what we're now seeing with this escalation going on in Turkey. Now, this is real money, and it has a real impact, but I think that the knee-jerk reaction is take a step back, stand on the sidelines. And I think that now people are trying to figure out what is that that impact on the emerging markets around Turkey. Clearly, we're seeing that impact in the euro over the last couple of days with the weakening of the euro.
Okay, Romain, so you guys agree on investors sort of taking a step back, going on the sidelines, but how much is investor fear driven by concerns of contagion? Are we seeing signs that this risk is spreading to other countries?
Well, I'll tell you what one trader told me on Friday that I thought was pretty prescient was he said that this was less about contagion right now and more about risk aversion. And he really pointed out the distinction that when you think about that Turkey's, imports are about a tenth of what China's are, when you think about the fact that its external debt is much smaller than what Greece's was back during its financial crisis, it shows you that the contagion risk, at least for now, is somewhat contained to that particular region. However, there is one big caveat there, and that is this idea that the global sort of landscape has shifted. We don't have the same sort of monetary policy accommodation that we've been used to, and we don't have a lot of the same growth metrics that we were used to. So there is some concern that with the potential for a slowing economy worldwide, combined with the lack of central bank support, that something like Turkey or something even bigger than Turkey could sort of rock markets. And I think that's why you're seeing some hesitancy in the markets over the past few days.
There doesn't seem to be many direct risks to the tech sector here, but what are some possible impacts there if this does spread to other emerging market countries?
Well, you're seeing to a certain extent in some of the European companies, particularly some of the telecom names like Vodafone, which is heavily invested in Turkey, as well as Telia, which also has a joint venture with Turkcell. Once you get beyond those names, there are a few microchip companies, NVIDIA, Micron, and then in the biotech space, Illumina, that have some broader EM risk, not just Turkey specifically, but in that broader EM space. But after that, you really just get down into some of the banks, some of the European banks, and only really two of the U.S. banks, Citigroup and Bank of America. Beyond that, most of the risk is really going to be found in really in the European side rather than on the U.S. side, much more on the financial side than it is on the tech side.
Crawford, real quick, it's all negative, sad news today, but is there any buying opportunity in all of this?
Well, again, just to be clear, IDC doesn't do buy, sell, hold recommendations. So I think that what you're going to see is that looking into this market, the telcos will be protected. I think that if you're the government of Turkey, having telco exposure, having people not be confident in those telcos, that's not a long-term strategy. What you see Erdogan talking about is we need to bring back confidence. We need to get people confident so that people will realize that in the long term, Turkey will survive the crisis that it's going through right now, which means that you'll likely see a scenario where we will move back towards stability over a period of weeks here.
All right. Well, thank you to IDC Research COO Crawford Del Pret and Bloomberg Television Markets Editor Romain Bostic. Coming up, Tesla, Theranos, and Yahoo, just a few of the names to pass through the SEC San Francisco office this year. We take a look at Silicon Valley's watchdog next. And later in the program, China's tech giants get ready to report earnings. We look at what's on tap for companies like Tencent and JD.com. This is Bloomberg. This is Bloomberg Technology. I'm Selina Wang in San Francisco, in for Emily Chang. The U.S. Securities and Exchange Commission's San Francisco office is no stranger to high-profile tech cases. The firestorm around Tesla is just the latest one to involve the regional unit. On Monday, CEO Elon Musk offered a bit of an explanation for his funding secured claim. Now, what might this mean for the SEC's investigation? Bloomberg's Ben Bain in Washington joins us now. Ben, lawmakers have said that a key focus was understanding whether it was truthful at the time when he tweeted if funding was secured. Now in this latest blog post, it looks like funding wasn't secured and there were just discussions. So how's the SEC going to look at this?
Thanks. So first, I mean, what we know so far is this is kind of a preliminary inquiry. So I don't think we can yet say it's a formal investigation or know exactly where it's going to go. But what we do know is that the SEC is really a disclosure-focused agency. And when you have the CEO of a company and its largest shareholder going out on Twitter and saying funding secured, it's going to raise a lot of questions. What we saw today was essentially an explanation 6 full days later of what happened. And, the response has kind of been all over the place. Some people think it, kind of puts a little bit of meat on the bones in terms of where he was. He didn't say deal secured. He just said funding secured. But others are a little more reticent to think this kind of solves really any of the potential problems here. I mean, essentially what Mr. Musk said today was that he had these conversations with the Saudi sovereign wealth fund, and that led him to believe that a deal could be closed. Funding secured, though, to some people, based on an 11% share increase, may have meant something different.
What do we know about the people at the SEC in San Francisco who are looking into this?
Sure. So we reported last week that that the SEC's enforcement attorneys at the San Francisco office, had been looking into some of Tesla's, public statements, even predating last Tuesday's tweet. What we know about the San Francisco office is just based on its proximity, it's very close to some of the high growth, large important tech companies in the country and really the world. So I think you mentioned before the break, the company formerly known as Yahoo, Theranos are just some of them that come to mind. And really, those are two of the biggest cases that the SEC has had this year. And those were both supervised, out of the San Francisco office. So, the fact that the San Francisco office is involved, and on one hand, isn't it really a surprise? But it's just kind of interesting to know that they certainly do have a lot of experience, kind of taking a look at issues like this. Again, we don't know that this is a formal probe or investigation at this point at all, but we did report last week that the SEC's enforcement attorneys in that office are looking into some of this. So
we've learned some new information since Musk's original tweet, but a lot of questions still remain. Lay out for us the critical pieces of concern here that the SEC is looking at. You mentioned one of them earlier, whether or not it was truthful and definitive when he said it at the time.
Sure. So I think what probably is again kind of worth looking at here is what did Mr. Musk know or think to be the case at the moment he made that tweet. I mean, that's from everyone we talked to, kind of going to be the focus of whatever regulators, do ultimately look into. And the other issue is also kind of how this played out. The SEC, going back to 2013, has said that it's okay for companies and executives to make statements about material non-public information via social media on Twitter. But in this case, so we have Twitter and we have the company's blog post this morning. We still don't have any filings with the SEC. An 8K is the form that would typically be used, that lays out any of this information. So I think the next thing we're going to be looking for is, what is the company actually going to come forward and tell regulators here?
This inquiry from the SEC is just preliminary. What needs to happen for an official investigation to be opened?
So, I mean, these things, it's worth noting, generally take a long time. And it's possible that the SEC will decide not to pursue anything here and that it won't ultimately even become a formal probe. Even if it does, though, become a formal investigation, these types of probes at the SEC can take months or even years. And it's not the kind of thing where they'll be out there, talking about it in the meanwhile. In terms of how these investigations typically proceed, there's an information gathering phase. Then they analyze it, and as you can imagine, eventually, there's a lot of back and forth between lawyers on both sides if it were to get there. But we don't even know that it's going to get there. We just know that there's an initial kind of preliminary, review going on here, scrutiny, and we'll see where that goes. But yeah, it can be a very long process, for any types of security violation cases to play out.
All right, Bloomberg's Ben Bain. We will be following that very long process very closely, and thanks for joining us. Now, sticking with Tesla, the electric car maker's latest controversy drew its first lawsuit on Friday. And Bloomberg's David Wesson interviewed one of the lawyers for the plaintiffs, Travis Lenkner, managing partner of Keller and Lenkner. He started the conversation by stating the grounds for his lawsuit. Take a listen here.
Well, we're suing on behalf of a class of investors who purchased Tesla stock between the minute of Elon Musk's tweet on August 7th that funding was secured and the close of trading on August 8th. And the damages measure there essentially would be the inflated price that those investors who were purchasing the securities on those days paid as a result of the market run-up that the false statements by Musk caused on the exchange and the trading of Tesla stock.
Have you done a back-of-the-envelope calculation and to see how many people actually did buy the stock during that period of time? Because it's a pretty limited period of time.
Sure, it's a limited period of time, but volume was incredibly high on both of those days, again, as a result of the market news. So volume was almost 4 times the running average on the 7th and almost 3 times the running average on the 8th. On the 7th alone, $11 billion in market clearing trades in Tesla stock. So even to take the percentage of damages from those purchase prices that would be a result of the difference in price as a result of the tweets and the various public statements, and it's a significant number even for the short class period.
And take us through exactly the legal theory, if in fact there is liability, or what would it be based on? Is this a securities law violation, 10b-5?
Yeah, this is a federal securities law violation. You know, live by the Twitter, die by the Twitter. Public statements on behalf of the company are public statements on behalf of the company. They have to be accurate. And in fact, back in 2013, Tesla advised investors that Elon Musk would be tweeting about company news, and that investors who wanted up-to-the-minute information about the company could follow his Twitter account. So the fact that these statements were made publicly and that they were false and knowingly false when made, or that they were at least made with a reckless disregard for the truth, is the source of liability here. And of course, all the reporting that we've seen subsequent to those initial statements bears out pretty conclusively that funding was indeed not secured, and that the company is in the very early stages right now of trying to secure it.
Yeah, I must say, Travis, one of the things that struck me about your complaint is I don't remember a complaint that quotes so extensively from the media as well as from the defendants themselves. I mean, you've got his entire memorandum to the shareholders. You even quote Bloomberg at one point about what we were reporting.
Well, David, we rely on the best, of course, but that investigative reporting has been really solid over the last several days, and even the commentary this morning on the program, I think, shows they're scrambling to decide how and whether they can put this funding together. But that, of course, proves that it was incredibly false to say that the funding had been secured almost a week ago now.
Turning our attention to crypto, the Winklevoss twins say they're not deterred by Wall Street's slow embrace of cryptocurrencies. The twins are going to focus on retail investors to grow their business after the SEC rejected their proposal last week for a Bitcoin-based exchange-traded fund. Speaking to Bloomberg News, Cameron and Tyra Winklevoss, who run the Gemini Trust Co-Exchange, say while Wall Street remains on the sidelines when it comes to cryptocurrency markets, there's another retail investor interest to drive growth. Coming up, it was supposed to be a smash hit video game for Tencent until the Chinese government said not so fast. How regulators could impact Tencent's earnings this week, next. Plus, Silicon Valley is flooded with billionaires from tech giants, but who are the lesser-known names prospering in the industry? This is Bloomberg. Chinese regulators have dealt a blow to Tencent's gaming ambitions ahead of its second quarter earnings set for Wednesday. The social media giant was forced to remove a hit video game called Monster Hunter World from its PC download service. Worldwide, the title has sold over 8 million copies, and officials said they received a large number of complaints over the game's content. This is not Tencent's first run-in with Beijing's video game regulators. Officials have already forced the company to change its popular mobile game Honor of Kings over its addictiveness and gory content. But Tencent isn't the only Chinese tech firm with a rocky start to the week. FOXCONN, one of the main makers of Apple's iPhone, posted a surprise drop in profit Monday. FOXCONN, also known as Hanhai Precision, saw net income fall 2% to $568 million. The news comes amid slowing demand for Apple's iPhones. Foxconn relies on Apple for more than half of its sales and is seeking to change that with ventures including a panel plant in Wisconsin. Here to discuss this and look at upcoming Chinese tech earnings is Isaac Stone-Fish, Senior Fellow at the Asia Society. Isaac, we saw that surprise drop in Foxconn's earnings partially because of slowing demand for iPhones. How can they successfully wean themselves of being so dependent on the iPhone maker?
Foxconn's founder, Terry Gou, for the last several years has really been trying to find out how does Foxconn exist a little bit more independently of Apple. Right now, I think roughly 54% of the company's profits come because of its relationship with Apple, and I think he knows well enough that this is not the way to have a successful business, to be such, almost like a subsidiary to Apple in some of these ways. So he's spun off a company, I think about several months ago, which is trying to focus more on the high-tech space. He's trying to make Hanhai or Foxconn be more of an AI innovator in itself and less just a place that manufactures and puts together parts for other companies, makes a lot of money doing it, but I think he wants to climb up the value chain.
And we have a whole slew of tech earnings coming out of Asia this week and next. Are you thinking that we're going to see any impact of the tariffs on their earnings announcements, or is it too early to say?
I think it's a very important question. I think if we do see a negative impact, it's a really good sign that investors are gearing in for a long-term, not necessarily a slowdown, but a long-term hit because of U.S.-China trade tensions. And conversely, if all of the declines or increases we see from expectations of some of the tech companies' earnings are mostly positive, then I think that's a sign that investors see this as just a little blip and that it's not going to have a big push on the economic story.
And we have JD reporting this week and Alibaba next. They both have pretty small parts of their businesses that are exporting to the U.S. But what are some of the other risk factors that these companies could be facing? We've heard many of Alibaba's executives come out publicly and say that these tariffs are going to hurt the greater Chinese economy and relationships.
So the most important asset that any Chinese firm has is its relationship with the Communist Party. Alibaba famously purchased the South China Morning Post, a newspaper that was sometimes critical of Beijing, as a way, most likely, to help curry favor with Beijing. So I think risk factors that rarely get discussed for Chinese companies but are very important are: what is JD's top leadership's relationship with the party? What is Alibaba's top leadership's relationship with the party? We saw that a little bit with the news from Tencent and the banning of this very, very profitable video game. Now, it's unlikely that Chinese regulators thought, oh gosh, a lot of people are complaining about this, therefore let's pull this very profitable game. Much more likely is that it's some sort of sign or a signal to Tencent to make sure that it stays in line with what the Communist Party's goals are for the company and for China.
And how much of Tencent's struggles do you attribute to these regulatory concerns, or do you think there are some actual issues with their core business?
I mean, I think a worry about this is that Tencent, before it built the hugely popular WeChat, was a gaming company. And if they are not able to figure out how to license a very successful game and make it work in China, the game had, I think, 1 million pre-orders before Beijing pulled the plug. If they're not able to do this, then it's just a really worrying sign that maybe they're growing too big, too fast, and they are moving away from their core competencies in a way that is not helpful for the business.
Right, Tencent for a while was seen as this unshakable gaming and social media giant. What is the signal exactly that the Chinese government is trying to send to them?
It's very difficult to know. It's possible that it's much more focused on what they think the games are doing to China's youth. I think more likely is it's a reminder to Tencent that the party is the one that makes the final decisions. WeChat has, I think, roughly 1 billion users worldwide. It is far and away the most popular Chinese app for messaging, for ordering food, for ordering taxis, and it is, on the one hand, a nice ledger that the Communist Party has the ability to see all of these transactions and all these communications between people, but I think Beijing also wants to make it very clear to Tencent that this product cannot be used in ways that go against Beijing's interests.
All right, Isaac Stonefish of the Asia Society, thank you always for joining.
Thank you.
Coming up, the unicorn elite are sitting on $60 billion in untapped wealth. We'll break down the big winners next. This is Bloomberg. Data privacy for Google users is yet again being called into question, this time over location services. An Associated Press investigation found that several Google services on Android and iPhone store your location data even with the services turned off. According to the AP's report, location services, when paused, will only prevent activity from being saved to your account's personal timeline. It does not stop Google from storing data from other location markers. Tech giants like Facebook, Amazon, and Microsoft have created billionaires like Mark Zuckerberg and Jeff Bezos. But it's not just publicly traded companies producing enormous wealth. The rise of Silicon Valley unicorns has created an unprecedented paper billionaires club where pre-IPO valuations have built up founder stakes of private companies like SPACEX, Airbnb, Uber, and WeWork to over $60 billion. But unlike Bezos and Zuckerberg, the untapped wealth of these new tycoons is tied to ambiguous company valuations. Here to tell us more is Bloomberg's Tom Metcalf, who covered the story in Bloomberg Business Week. Tom, we're talking here about $60 billion of untapped wealth. Is this unprecedented? Are we at a peak here?
Yeah, I've been tracking this for several years, and the trajectory is only going up. And, you know, in recent times, that's kind of been driven by SoftBank, and I think just generally the whole startup scene is incredibly bullish right now. And that $60 billion figure is just gigantic. Right at the top, Elon Musk with something like $14.6 billion tied up in SpaceX. And even the guys right at the bottom have got 10-figure stakes. So it's just an incredible amount of wealth, but I guess the key point is it's sort of paper wealth, and the challenge is how can they monetize it? Do they crystallize it? And, you know, I guess will it come to pass?
Right, and these tycoons are matching up their valuations to these private markets, which can be rather foggy. So how closely aligned are the estimations of their net worth to reality?
So there's definitely wealth here, and you can see that from the unicorns that have gone public, you know, Snap, Dropbox, they've all ultimately gone public at very big valuations. The interesting thing is when you look at someone like, say, Uber, and these valuations just seem to vary dramatically, you know, from the headline figures we sometimes hear about. So Uber, take the SoftBank deal, Uber raised money at $1 billion, $70 billion when it took $1 billion from SoftBank. But then existing shareholders sold at something like $48 billion. So you've got this very big discrepancy, and sort of putting an exact number on that is definitely more art than science at the moment.
Right, and at the top of your list was Elon Musk, who we've been discussing extensively on this show. His personal stake in SpaceX is valued at $14.6 billion. Is he likely to tap into that anytime soon?
Oh, no, absolutely not. He's probably the extreme example of this wealth all being on paper, because he's kind of gone out there publicly and said, hey, SpaceX is not going to go public until we start flying regularly to Mars. So who knows when that will be. And, you know, in terms of sort of to reassure investors and such like that, he's not really going to be able to monetize any of that stake at all. So then he obviously looks at Tesla, but he's thinking of taking that private as well and saying he won't reduce his stake at all. So he could be a $25 billion guy, but actually pretty cash poor.
And there is a rule change that's being considered in Congress right now that would allow some of these big-time unicorns to sort of gauge big-time investor interest before taking the plunge in the public markets. What impact do you think that's going to have? Will we see more IPOs as a result of this?
You know, I think it's really interesting. News just come out today, and you suspect it probably will, because they just have a bit more certainty about the kind of valuations that they're likely to hit on that first day of trading. You know, funnily enough, it might be more beneficial for the smaller companies companies out there, say not the Ubers or the WeWorks, which have bankers galore, but perhaps the smaller unicorns where they can get a bit more certainty that, hey, we'll be able to move from private to public and still see these gigantic fortunes and these gigantic valuations come to pass.
And you mentioned Uber earlier. What are some of the most egregious examples of just how spongy private valuations can be?
So I think probably Palantir is the real standout. So in 2015, that raised funding at about $20 billion. And investors were sort of blown away by the possibilities offered by this data mining venture. Since then, they haven't really kind of delivered. So what you're seeing is companies like Morgan Stanley, which do own stakes in them through various funds. Some of them have marked down Palantir from $20 billion in 2015 to I think it's $6 billion for Morgan Stanley at their latest mark, which was the end of May. So I mean that's a huge discrepancy, and the impact it will have on the founders, who include people like Peter Thiel, Alex Karp, is their paper wealth could be in the aggregate $8 billion if you believe Palantir is worth $20 billion. If it's worth $6, they're practically paupers with about $2 billion or so.
And that does it for this edition of Bloomberg Technology. Tune in tomorrow when we'll be speaking with a slew of NBA players at the Players Bloomberg Tech Summit, including all-star Jaylen Brown of the Boston Celtics. That's all for now. This is Bloomberg.